This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us today to take a look at the market trade as we wrapped up the week on Friday with plenty of risk-off momentum in the markets. A lot to discuss. We bring in our good friend Ted Seifried with Zaner Ag Heads joining us today. Ted, good to catch up with you, buddy. How are you?
Yeah, I'm doing great, Jesse. Thanks for having me, man. As always, it's a pleasure.
Well, I know it's always good to catch up with you, but on a day like Friday, market trade just pretty rough. It's not a pleasant thing to talk about, but really just generally risk off across the board. I know we could dive into this more detail, but just your general thoughts wrapping up the week with all the risk off momentum we saw, which I assume a lot of it tied to that screaming U.S. dollar just moving higher.
Yeah. Well, it's all kind of moving in tandem, right? And Jesse, we've been talking for months about the possibility of these macroeconomic factors, these broader picture things really coming in and affecting our grain markets, our agricultural markets as a whole. And to some extent, it's really been doing it for the last few years. For a while, it had been to the positive because of inflation. You know, you look at a current corn balance sheet, it's rather tight. But you go back 2 years with a very similar corn balance sheet to what the USDA is projecting right now, yet the average price, average on-farm price, was under $5. You're looking at corn at 6.75, even on a bigger down day. You have to be cognizant of that. And if the winds of change are coming, it really feels that way. You got to realize that there's a good portion of the pricing of a lot of these commodities that can come out, even if the individual market fundamentals don't change. And I think Friday today is just a very big reminder of that. And like you said, risk off. I mean, you look at crude oil down $5. The stock market just really plummeting in the last few weeks, but really accelerating this week because of the Fed language, not just the rate hike of 3/4 of a basis point that was expected. It's the language that they're using about continuing to aggressively raise the rate between now and the end of the calendar year and beyond. And the market just does not feel good about that. You have a lot of global tensions, just a lot of things kind of adding up to put a lot of pressure on markets across the board. And that comes at a time where you've got seasonality for normal downside pressure in the grain markets because of harvest. You know, we get in, that's when the glut of cash hits the market, even though we seemingly have a smaller corn and soybean crop than what we were thinking 3, 4, or 5 weeks ago. But now we've gotten that out of the way for the most part, right? I mean, any changes in yield that we see from here on out will probably be fairly minimal. I think corn can come down just a little bit. Beans might actually come back up a little bit. But the big shocks are out of the way on the production side of things. So now the market has to focus more so on demand. And that's when we start talking about the macroeconomics of the things, right? Because a lot of that export demand, specifically to China, well, that might not actually be there if China's in a major recession. And if you look at what China's bought so far this year, it's a lot of it's been front loaded, but they're well behind the pace they normally are. That's a concern. I mean, look at our export sales from earlier this week; they were pitiful. Argentina is selling very aggressively under their currency exchange program. How much is that taking away from our export sales? We could easily put another 100 to 150 million bushels back on the soybean balance sheet. All of a sudden, we're at a 350 million bushel carryover, and that's not an overly tight scenario. And in my mind, it really doesn't justify 1425, especially in a climate where we could be heading into a global recession. So, yeah, I want to sit here and say, look at a 200 million bushel carryover in soybeans, and if that demand is even a little bit encouraged, it could get even tighter. That's the bull story. But on days like today, you have to see the bear side of things too, and you have to understand the possibility of where things could be going here over the next few months.
Yeah, very true. Well, and I think about this as well, and you brought up demand, and I was going to bring that up as well here today. It feels like that with the macro markets to wrap up the week, a lot of traders kind of running for the door, and the macro markets and demand is doing its job, doing the best job it can to maybe ration some demand here at the end of the week. Whereas, heading into the Fed news and everything this week, it felt like maybe the cash market, we were kind of leaning on the cash market to ration demand. So, do you think we're maybe seeing that shift now from maybe the cash market to the macro side, maybe rationing some of our demand here moving forward, Ted?
Yeah. Well, you think you kind of let off with it though, Jesse. There's another thing that is also helping to ration demand, and that is the sharply higher US dollar, right? And when we talk about exports, well, even if you have beans down 30 cents, but then you have the dollar up 700 points, that's not making soybeans any cheaper for the rest of the world. So, you've got demand rationing happening in a number of ways. Demand destruction, I think, happening in a number of ways. And again, our export sales report was a good reflection of that. But these are historically higher end prices. So that by itself is going to do that. They say the high prices are the cure for high prices because it brings out supply, i.e., look at Brazil going to plant everything, and it also creates demand destruction. And I think now that we've got stock market under so much pressure, you've got crude oil under so much pressure, you see this demand rationing finally happening. We had gone about 2 years without it happening at high prices, which is an abnormally long period of time. But that is now finally starting to kick in. And again, it's being helped by a bunch of things: high prices, high dollar, uh, really poor stock markets globally raising interest rates.
Mhm.
Everything's fighting inflation right now. And when you're fighting inflation, that's exactly what you're doing, Jesse, is you're killing demand because the products that you make, if people are willing to pay higher prices, if people are okay with the inflation, then the input costs that go into it, the raw inputs, corn for ethanol, corn for feeding livestock, soybean oil for biodiesel, soybean meal for feeding livestock. If we're paying the higher price for the products, then the high price inputs are justified. But if people are no longer paying the high prices for the products, then we can't have the high price inputs because the products back up, the inputs aren't needed. That's what demand destruction is. And again, unfortunately, it just really feels like this is a sort of event where that's happening and it's culminating from multiple different angles.
So, Ted, let's bring this back to the farmer perspective. They hear all of this. They hear this talk of demand destruction. They're seeing a rough down day on Friday in the grains. They're getting into harvest. They're looking at maybe some marketing. Are they going to sell off the combine, etc.? So, I think it's good to remember that if I'm a farmer, not to get too emotional on a day like this, but also it's important to really take a look at that marketing plan and make sure that you're on top of things even as you're busy during harvest, I would think.
Yeah, absolutely. I mean, you got to be checking markets on your phone and things like that. And don't freak out because of today, but don't ignore it either. It is a really bad thing to ignore days like this. I mean, markets are constantly telling us things. Sometimes they don't have a very loud voice. Sometimes you have days where things are wishy-washy and mixed and whatever. That tells us things too, but it's not as obvious as days like Friday. Days like Friday are making an obvious statement. This is a market making a statement. And understand that statement. Don't get emotional about it, but take that statement and do with it what you will. If you don't have a whole lot sold, days like Friday are very much suggesting, warning you that things could get really nasty in a hurry. So maybe take some action. Look, predicting the future is an SOB. It's fickle, right?
Mhm.
Something can change tomorrow. But as of right now, in this very moment, Jesse, you have to feel like, okay, we are on some thin ice. The risks that we have today are far greater than what they were 4 or 5 months ago, or this time last year. This time last year, that undercurrent of inflation felt so strong that even poor fundamentals weren't really going to knock us down. And that was the case last year. That is not the case this year. We have to understand we're dealing with a different animal. Now, could this happen one more year where inflation is hot and heavy, stagflation? I mean, there's a lot of people that want to hang on to the idea of sticky inflation. Maybe. But the fact of the matter, Jesse, is that over time, high prices are the cure for high prices. Demand destruction will occur. And when you see these things happening in the outside markets, you have to be on super high alert that now is the time. We've gone a much longer period of time than we really ever have in the recent history. I mean, look at 2012. We only had high prices for 1 year because what did we do? We destroyed demand for the next 6 years. That's going to happen again. It's taken longer than it did in 12. Is it happening now? Is it happen 6 months from now? I don't know. But you look at the markets on Friday, you look at the stock market, you look at crude oil, you look at everything, and you say, it really feels like now's the time.
Well, Ted, in the face of everything, we're seeing in the markets and just kind of the worry that's out there, I know farmers are concerned about the cost of inputs for next year. And if we're seeing demand destruction and markets retracing, et cetera, yet input prices remain high, that's a whole nother wrinkle, a whole nother thing that you got to sit down with your pencil and take a look at, I would think.
Yeah, but a lot of these things are all kind of tied together. I mean, you look at what's happened in natural gas; it's sharply lower or sharply off its highs, and that chart looks really bad too. And that won't be unaffected by demand destruction. All right.
Mhm.
That being said, my bigger concern, Jesse, is for the guys that have already booked inputs for next year for fall field work and also for spring, and yet haven't taken anything to manage the pricing of the outputs of the price of corn, right? If you haven't done that, you're really running the risk of, this is in 2008, but remember 2008, where you had corn almost at $8, ended up in the low threes. If you had booked inputs at a really high price, and then you sit there and wait and watch these markets implode for reasons outside of actual grain fundamentals, you have a potential to be wildly in the negative this year. And I think, unfortunately, there probably will be cases of this happening. It'll be a great opportunity for people that have managed well and have nice profit margins. The fact of the matter is, look at the prices that we have on the board right now, even on a big down day, you are still can be really very profitable. And for the guys that are, they might have a really nice opportunity to go in and pick up some rents that their neighbors just can't afford anymore because their banks aren't willing to give them loans when they're so wildly negative on their profit margins. I hope that doesn't happen, Jesse. But that situation is what's setting up in front of us. And you have to do everything you can to make sure that you're not that guy.
Ted, as well, let's talk the livestock market. A down day there on Friday. Hogs finding a little bit of pressure this week, it appears, while cattle kind of just trading mixed. I know cattle on feed report out Friday afternoon. We'll see what those numbers look like. But it feels like a lot of the same storylines possibly here in this livestock sector as we look at retail demand, export demand, et cetera. A lot of the same things, a lot of the same concerns we have to watch in cattle and hogs right now.
Yeah, absolutely. In cattle in particular, when we look at big declines in the stock market, we really get afraid of demand destruction at the butcher's counter. Um, and it has been a heavy week for cattle. We ventured into the 152 area, finally trying to break out to the upside there earlier in the week, and then failed, and then spent the next 3 days really precipitously falling off. And so now the look on the cattle chart is just not good. It looks like a failed attempt at a breakout that we've tried that level 7 or 8 times and just not been successful. So that it feels like we're in store for a deeper correction. And then when you look at what's going on in the stock market, you kind of understand why. So that's the problem there. Maybe cattle on feed gives us something to shake that off, but we were expecting some fairly bullish numbers. I think it would have to be really rather bullish in order to get the ship righted again. But I don't know if that happens. Um, you know, Hogs are the ones that I find interesting. I've been saying for a while that I wonder if speculators find interest in hogs because of the cheaper protein, the alternative to beef. Maybe people are going to, that's the recessionary buy, right? Let's buy some pork because the ribeyes are way too expensive. Let's get some pork chops and we're still getting our protein. We're still happy. And if I'm being honest, the hog chart doesn't look as bad, even though Friday was a much bigger down day for hogs than it was for cattle. The hog chart doesn't look quite as bad as the cattle chart, in my opinion.
Mhm.
We've kind of got this sideways range, and I wonder if that is maybe one of those recessionary plays where hogs might just continue to go sideways for a while. Either way, Wednesday, Thursday, Friday wasn't a good look for anything in the livestock sector. A lot of downside pressure, and like you said, it's tied into risk off. It's tied into the amount of carnage we're seeing in the stock market, and the fear and the real it's sort of panic out there. The last 3 days of this week were really very panic filled when it comes to trading in commodities.
Let's say I know another issue for the cattle guys out there as well that we've talked about and we're watching is the feed availability in the southwestern feedlots. I mean, a lot of this talk about how can we get corn from the east to the west. We still haven't completely solved the rail strike issue. They got to vote on it. I know trucker shortages, et cetera, and then of course the cost to book in that corn and move it to the feedlot. So I think those margins for some of those guys in the Southwestern Plains, that's going to be a big story to watch here as we go over the next couple of months.
Yeah, and that might mean you have a lot more cattle coming to market in the shorter period of time, which makes it a real uphill battle for that December contract, for example, to fight its way back. It might be bullish longer term, but then you wonder, okay, what's our economy look like in March, April, May timeframe? The other thing I'm going to pick out of that, because there's a lot to unpack there, Jesse, but the truckers, trucker availability. I think that problem is starting to fix itself a little bit because you look at the big box retailers, Walmart's, Amazon, just all of them, the brick and mortar ones. Their inventories are just so far backed up, they don't need as much right now. So there's a lot of truckers that had been hot and heavy, during the pandemic when everybody was buying TVs and everything for their houses and whatever, Home Depot, they don't need to replenish their inventory as much. So I think there's going to be more trucker availability over the course of the next few months. I don't know if that helps the guys in the southeast. It's going to be very difficult. That's not the typical way we go with grain. It's going to be very difficult to get things there, and it's going to cost a lot, and that's going to really, like you said, cut into margins. So what are the options? Are we going to go to market sooner? Are we not going to put cattle on feed? I don't know. It doesn't look great, but in the short term, I think that just means more marketing. That means more upfront supply, and that means that it's going to be real hard for that December contract to find a whole lot of traction.
Well, Ted, fantastic stuff as always. I'll open the floor to you and give you the open-ended final thoughts question. Again, we covered a ton on Friday, and just that general risk-off tone. But I'll leave it to you. Anything else we haven't mentioned, or anything else you want to reiterate here today?
Yeah, I want to stress, like, let's not get stuck in the bullish balance sheets that the USDA gave us, because a lot of that can change. All that demand is implied, it's estimated, right? And if things are changing on a macroeconomic scale, that demand can go away, and carryovers can grow rather quickly. So don't get married to balance sheets. Don't get married to bullish narratives. If things are changing, change with them, right? And in the meantime, the good thing to take away from this is that energy prices have come down pretty substantially. I mean, remember when we were talking crude going to 175? It didn't make it, but we got to some very lofty levels of crude oil. Now you've got December crude at $78, and that's the lowest it's been since February. You've got natural gas down sharply. So there is some relief coming on the energy side of things, and therefore, nitrogen and inputs, hopefully too. But don't just always focus on the positive. I mean, understand the risks that we have in front of us. Understand that hey, this might be bigger than just a USDA balance sheet for corn. This might be a global thing that we have to take action on. And then again, final question, Jesse, and I'll let you go because I know you got to run. But if you could go back to 2012 and have the foresight to sell the next 3 years out, would you do it? Well, you might be looking at the exact same situation right now. So I don't know. Just keep that in mind. I mean, keep in mind the really historically good prices that we had. Yeah, they're not the highs, but look, $14 plus soybeans, $6.75 corn. Wow, man. I mean, how many times do you wish you could go back and sell that?
That is a great point, I think, to wrap up on. Ted, if folks need some advice and they want to talk with you and the team there at Zaner Ag Hedge, what's the best way to do that, Ted?
Yeah, you can reach me directly at 312-277-0113. You can also find us on the web at www.zaner.com. You can sign up for our morning newsletter. It's a newsletter. It's not a recommendations letter, but keep you up to date on the news. And then you can also find me on the Twitters at the Ted Spread.
Well, Ted, always a pleasure, sir. A busy day, even with all the risk off and everything going on. But appreciate you joining us, and thanks for the time. Enjoy your weekend. We'll get you on again real soon, Ted. Thanks so much.
Thanks, Jesse. Sorry to be Debbie Downer on a Friday, but I mean, sometimes we just got to talk about the hard things. So,
Hey, you know what? We could be a Debbie Downer, but at the end of the day, the weekend is in front of us. So that's
yes,
something we can take as a positive, right?
it's Friday. Right. No
Ted,
markets tomorrow.
yeah, exactly. Appreciate it, buddy. Thanks so much for the time.
Thanks, Jesse. Take care.
Ted Seifried, Xander Agheads joining us here today on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.